Welcome back, passive income investors. Like today, I want to compete the U.S. versus the Canadian banks. What is the better buy? What should you buy, guys? If you want to know, I own some of these banks. I'll leave the link in the description below to my entire portfolio breakdown, my six-figure portfolio, where I show you the three banks I hold, which in fact there are these ones right here: Scotia Bank, Bank of Montreal, Canadian Imperial Bank. Make up some of my largest holdings in my portfolio. But I want to show you something that I found really interesting about banks. And if you don't invest, if you are new to investing, a bank should always be a part of your portfolio, your diversified portfolio, guys. But I want to show you the differences between these banks and the similarities that I just find interesting about the banking sector in general. Starting with, it doesn't matter the size, guys. You're going to notice some of these banks are huge. We're going to analyze the largest banks, but I want to scheme over all of these balance sheets really quick to show you guys something I found kind of interesting, starting with the Canadian Imperial Bank of Commerce. Their total assets and their total liabilities, you're going to notice every single bank. This is what I want you to pay attention to, because they all follow the same suit. They all follow the same line of thinking. As you can see here, we're going to say it just comes down to size and who has a higher asset basis. But you're going to notice that their assets versus their liabilities, if you were to minus these and see what you would end up with, you're going to find that they all have this similar percentage difference. Really interesting. Here's the largest bank in Canada, guys, the Royal Bank of Canada. And even it, though it contains about $1 billion in assets here, guys, it follows the same percentage of liabilities, like the percentage of liabilities versus assets. And I've noticed that when you kind of bleed on over, maybe we'll look at one more, like the Toronto Dominion Bank, you can see it sits at 1.3 and they have a total liability of 1.2. It really follows the same suit. They've all had similar increases over time. And even if we scoot on over to say the American side, like Bank of America Corp, guys, you're going to notice these numbers just get slightly bigger, but they still follow. Well, look at the total assets in total. So the big number here, guys, is 2.3. And then if we go to total liabilities, we have an even 2. So you can see the very cool similarities in their books, even with this one here, which is Goldman Sachs, I think the largest one in the U.S., guys, which is also following the same kind of total current assets. We got what, 931, and total liabilities 841. So you can see it's almost the same thing. So it's neat to me how that works, guys. And if you want to follow their income, I mean, you can always check that out as well, which you can just go into their income statements, where we can see Goldman Sachs has had a very slow increase since 2015 in their total revenues. Nothing crazy going on. Same with most of the banks, I think, in general. Let's take a quick look at the income statement for Bank of America. Actually, we've had a nice increase in total revenues, so very healthy. If you guys want to know, I actually used to own Bank of America. It's one of my favorite U.S. banks for many of reasons, but one of them is this beautiful total revenue increase. Now, if we head on over to some of the Canadian banks, we'll go back to my favorite Canadian bank, which is Canadian Imperial Bank, and we take a quick look at their income statement. We can see a really healthy growth in total revenues, operating income. This company has done a nice job with stuff, guys, but I've noticed that, again, if you go through every single bank, they all follow a similar suit. They all, depending on their size and scale, vary, but the percentages seem to run in roughly the same course, which is steady and on your way up over time, guys. These things are like moats. This is why I think they should always be in your portfolio. They're like tanks. They're machines that the government bails out even if they fall apart. So they are incredible features to have in that diverse portfolio of yours. Now let's just go on over to my next interesting things, which is the dividends. Y'all probably want to know about the dividends. So I want to compare some things here, because the big difference between the Canadian and the U.S. banks is their starting yields. If we can go to the overview here of, let's just take Canadian Imperial Bank, pays out one of the highest starting yields of all the banks in Canada here. And then let's go over to, say, Bank of America, or even, let me drag this one over as well so I can get these together. We'll say Goldman Sachs. So most Canadian banks are right around 4%, at the highest 5%, the lowest is like 3.5%, 3%. But let's look at Goldman Sachs. Starts at a 1.6% dividend yield, guys. Bank of America starts at a 2.1, which is another reason I'm more gung-ho for Bank of America. But again, guys, these Canadian banks pay out a massive yield starting. And if we want to see the breakdown real quick, since 2014, you'll notice the Canadian Imperial Bank was paying out roughly $1 at the beginning of 2014. Skip 5 years later, we're sitting at $1.36, which is quite a hefty increase. That means you'd probably be making closer to a 7%, I'm going to say somewhere around a 7% yield overall, your yield on cost. This is a very healthy increase, guys, to go from 1 to 136 consistently too. I want you to take a look at the consistency of every few quarters. It's not even once a year. It's like every few quarters, even maybe once, even a quarter if they can. They seem to want to increase that dividend, and they've done it really steadily over time. It's a very impressive thing to look at. And then if we go over to say something like a Bank of America, Bank of America, we're going to take a quick look at these dividends because you'll notice the consistency is a little bit different. So this one has actually had a higher percentage increase since 2014. For some reason, they were paying out 10 cents forever. I don't know. Look at how long they paid out 10 cents for. And then out of nowhere, after a very long time, you can notice they've lowered their dividends since 08. That big crash did some damage to these guys. But let's not worry about that. We want to look at the last 5 years. So we're not going to care about the 08 crash. Obviously, it hit the U.S. banks a lot harder than it hit the Canadian banks. But the Canadian banks are also insured by the government, just so you know. Anyways, 2014, guys, we had a 0.05% dividend, nothing crazy impressive. And then if we skip to today, we've pretty much doubled that dividend. So in 5 years, they've doubled the dividend, just actually well over doubled it, which means you have a nice healthy increase, but you still wouldn't be on the same level as the Canadian banks. And when you're comparing these balance sheets and you see they all kind of follow the same suit, the economy in that sector all follows this kind of same steady increase. There's no bank just blowing it out of the water. Sometimes other ones do slightly better than other ones, but in relativity, guys, I don't think any of it really matters. So you just want to buy banks when they're on dips, whatever bank pays the highest yield at the best dip, because honestly, if you're going to compete these together, guys, I don't know what one's going to do the best. Like here's Canada's largest bank, and if we go back to 2014, paying out the same sort of suit, guys, 71 cents, and today it's paying out almost $1, and you can notice it's increased it yearly, almost quarterly, every few quarters, same sort of deal as Canadian Imperial Bank. And then we go to Goldman Sachs, and sorry, I couldn't find a good chart except for here where we're showing good history. We go back to 2014, and again, we went from 0.55 to 0.8, which is nothing crazy when you're only starting at a 2% yield, which again, guys, if you're buying banks, you're not buying them for capital growth. In my opinion, you are buying them for this dividend, which is why these dividends matter. And I think if you're going for cash flow, stay away from the U.S. banks. I do think the banking sector in general is undervalued. If you want some diversification, then maybe consider looking into Bank of America. It's one of my favorite U.S. banks, guys, and maybe diversify a little bit that way. But when it comes to comparing, I only own the Canadian banks. Like I said, I used to own Bank of America, but I'd rather hold something like Canadian Imperial Bank. I don't have to deal with any deductibles on the taxes or foreign income tax. And on top of that, I'm getting a much better dividend yield starting. So if I need that cash flow today, here it is waiting in my account, paying me quarter after quarter. So overall, guys, I love the Canadian banking system. There's a lot of crap going on with it right now. A lot of people shorting it, thinking the housing market might correct. People have high loans. I don't know. People always bash the banking system. But in any of these dips, guys, right now I'd be buying these. I want to buy some more very soon of the Canadian Imperial Bank if I can, and more BMO. BMO is another really nice one that I'm buying, but I'm more or less going for this high percentage yield. That's why I own about $16,000, $15,000 worth of Canadian Imperial Bank. I own about $10,000 worth of Bank of Nova Scotia and another $5,000 of BMO. BMO was a new position I took on this year, and I was getting it over a 4% yield. You always want to get these banks on the dips, guys, and they always have dips. Don't hesitate when it dips. Just start picking and accumulating slowly over time. And sure enough, sooner or later, it'll work out. Trust me, it always seems to anyways. And like my mom always said, if the banks go bust, the money in your pocket's just as worthless. So I want you guys to let me know what you think in the comment section below. What banks do you own? And did I miss anything in this thesis of mine about why I love these banks and their dividends? And they're just general, like a tank fundamentals, guys. These fundamentals go right out of the water. You guys can do your own homework and fully analyze their cash flows and figure out what bank would be the best bank for you to own. But I love the banks, guys. Never hesitate buying these in my own personal portfolio. But remember, I'm not a financial advisor, so this is just for entertainment. But stay cool, stay super awesome, guys, and I look forward to talking to you tomorrow.